Welcome to the Mastering Commercial Real Estate Podcast, the show where we dive deep with top investors, operators, and industry pros to uncover how they're building wealth and creating real impact through commercial real estate. I'm your host, Cory Mortensen, capital raiser, commercial investor, and founder of 19 Holdings. Whether you're just getting started or looking to level up, this podcast is your go-to for real insights and actionable strategies. If you enjoyed the show, please hit that like button, leave a quick review, and share it with someone who should be listening. If you've got feedback or ideas to improve the show, I'm always open and I want to make this better for all you listeners. If you're ready to start building wealth passively through commercial real estate, visit 19holdings.com. That's ONE-9 Holdings to learn more and join our investor list. Enjoy this episode. All right. Hey, everybody, and welcome to the next episode of the Mastering Commercial Real Estate Podcast. I'm your host, Cory Mortensen, and today I'm joined by Jack Sorenson, who has helped lead investor relations and capital growth over at 4 Mile Capital. He's got a strong background in multifamily brokerage. Jack brings a unique blend of real estate expertise, leadership experience, including a past career as a professional athlete with the Cincinnati Bengals. He's also passionate about giving back, serving as a co-founder and board member of the Passion Projects nonprofit. I'm excited to dive into Jack's journey across sports, real estate, and social impact. Jack, thank you so much for being on today.
Yeah, I really appreciate you having me, Cory.
Yeah, so very excited to have you. And we had a pre-show call that went really, really well. And so I'm excited to dive into a lot of the details that we had went over. But just start by going ahead and introducing yourself to the audience and the listeners. Tell them who you are, where you're from, and where you are today.
Yeah, happily. So a little bit on my background. I'll try to give the condensed version. I know we talked pretty in depth about this before, but from Chicago, born and raised, kind of both my parents are from Green Bay, right? So was born and raised with like football and cheese curds essentially were like the two driving forces of my life. So really caught on to the football thing. And like you said, had a short stint background with the Bengals. So that was great. And actually through football was how I got exposed into real estate. My fiance's father, as well as a few people that I was surrounded with, helped me start looking into what those types of investments could do for me, and then ultimately my wife now, and got involved with some YouTube University stuff and tried to learn the underwriting and all that stuff. And when I ended up getting cut, found an opportunity to come out to Denver and jump onto the brokerage side of things with Matthews Real Estate Investment Services. So there's a natural synergy there. Kyle Matthews started Matthews Real Estate Investment Services. His brother is Clay Matthews, Bruce Matthews. So long lineage of football there. And after some conversations, had the opportunity to start up the office with a few other people and kind of take the helm of the multifamily. So I tell everybody this. I think looking back, if I knew what I knew now about those 2 years that I spent in brokerage, not knowing anything, joining early 2023 into a really difficult real estate market, I probably wouldn't have done it again, but it's the only reason that I've gotten the opportunities that I've gotten today. And in the position that I'm in today, forced to create a lot of great relationships, learn through a fire hose, learn how to underwrite with debt in a really volatile interest rate market, and then intimately learn an asset class. That's kind of a sink or swim situation where you're 100% of your paycheck is based off of the transactions that you do, and you don't have any senior help. So it was a really interesting situation, and ultimately did that for 2 years, then had the chance to join 4 Mile Capital, which we are a multifamily syndication firm. And we raise capital from family offices, high net worth individuals, and then place that capital on a deal by deal basis. So not a fund structure, but more so deal by deal capital raising to help these individuals get the benefits of real estate, but the passivity of investing. And then that my job is to manage those investor relations, find and allocate more capital. And then when a deal comes along, to raise the capital that we need to go and invest into the deals. So it's fun, brokerage, and now onto the sponsorship side.
That's incredible. And I'm definitely curious, and I know the audience is definitely curious. What were some of the lessons and some of the things that you learned being around some of these athletes in the NFL during your time there at the Bengals? What was some of the most pivotal memories that you have that maybe didn't translate straight to the field, but gave you a lot of the skills to go out and do what you're doing now?
I think the number one thing, and we're seeing it more so today, than probably in any previous time, is delayed gratification. I think that's a really important inherent skill that a lot of these top athletes have. And I saw that with every single person that I had the privileged to be around at the Bengals was everybody was really, really great at understanding that their goal might not be achieved for 12 months, 24 months, 36 months, 10 years, right? People chase Super Bowls and gold jackets and Hall of Fame opportunity for years and years and years. And that starts when you're 5, 6, 7 years old in Pop Warner and you figure out that you're actually good at this thing. And then you set your dream to do that, right? So I had an 18-year dream, and it took me 18 years to complete it. So now carrying that into what I do now, I think you're really comfortable being uncomfortable and understanding that your goal might not be achieved for months, if not years. A lot of people aren't comfortable with that, but I think that's why athletes do so well in brokerage and real estate in general, because you can have 100 deals fall through before you finally get that one. So managing your own expectations is something that I think a lot of athletes are pretty good at. And I saw a lot of these athletes that I had the privilege to be around in the NFL level be very, very good at. Never get too high, never get too low, and take advantage of the situation when they present themselves, but understand that they're few and far in between, so always be ready.
Yeah, and I think that's a great answer to that question, and that's a good lesson that I don't think we've spent enough time on with other guests talking about that. The delayed gratification and having that patience in this industry is so key if you want to be successful. There's such long time periods between each deal, and then each deal itself takes quite a bit of time, and there's no guarantee it'll end up at the closing table and no guarantee of a paycheck. If you want to get into this industry and you're listening to this podcast and you're thinking of ways, skills that you want to learn, patience and that delayed gratification is going to be a big one, because you're going to have to go long stints of time without a lot of wins. And especially in a market right now where things have really plateaued and things could kind of go one way or another, that's what we're seeing a lot, especially on the capital raising side. There's either two things: you don't have enough capital or you don't have enough deals. And my experience talking with a lot of other operators right now, especially when they're trying to find capital and new investors, that's something that is a new skill that people are having to learn, go out and find more investors. So for you on the capital raising side, what does that system and that strategy look like with your investor relations, finding new investors? What are some of the strategies that you're using on a day-to-day basis?
A very simple strategy. And, I've been blessed to come into a situation that was started back in 2016 by three co-founders, Chris Gear, Eric Mallon, and Terry Simone. Currently, Chris is our CEO and active co-founder in the company. And then Eric and Terry are now strategic advisors. So, but they had 7, 8 years of running the company before I came into the situation. So they really went through the woes and the ups and downs of figuring out how to identify that capital and then nurture it into a database, and then ultimately find great deals that aligned with the cost of capital that is their investors. So what I've been focusing on since I joined the company, because that's really what I can speak to, is how do you turn the current investor base that you have from investors into raving fans. And I think that is like such an important part of this, because what we do is not unique as in investing into real estate, right? So if people wanted to find an opportunity to passively invest into a syndication that is multifamily and find value add or stabilized Class A cash flowing deals, we're not the only company that does that. So how do we create a differentiating feel and process to our system? It's by providing a service level that's unmatched through institutional and then private client real estate. So that's what I focus on: is what is our responsiveness? How accurate and in depth are we in our responses to our investors? How timely are we with our K1 distribution? Are we always hitting our March 15th deadline? How transparent are we being and accurate are we being when we are distributing our investor reports on a quarterly basis? And then how responsive are we to the questions that come in from that? Do they always feel like they have the ability to talk to Chris, our CEO, or me, myself, or Ryan Atkins, our acting CIO and president? So it's all of those things that sometimes you miss investing with other companies, as you feel like you're a cog in the wheel or just a number. But we want our $50,000 investor and our $1.5 million investor to feel like they are getting the best service that they've ever gotten with anything that they're involved with, whether it's like, calling Costco to get a refund or working with us. We want you to feel like you have the best service when it comes to any platform that you're engaging with in your life. So that's my job. And ultimately, going back to turning investors into fans, What that does is if you provide a great experience, match that with great deals, hopefully they go and they tell their friends about you. And a warm referral or an introduction is the best way to garner new relationships. And that's what we've built our system off. So we've got around 550 active investors, and I don't want to quote myself on this. I'd have to check with Chris, but I don't think we've ever like paid for a leads list. We don't do any advertising because we're 506B. So everything is based off of warm intros and leads, and we've done a, pretty good job of doing that.
That's incredible. And I love that strategy because that is one of the highest conversion strategies, getting the warm referral, and it's going to be a higher success rate of getting them into your platform and getting them to invest in that next deal. What are some of the kind of tactical strategies that you've seen that have had success with talking to your investors and getting those referrals? Is it handwritten notes? Is it newsletter? Is it just kind of an amalgamation of all of the things that you guys are doing that you kind of mentioned, with the reporting and being timely and feeling like they can have access to you guys? Is there certain things that stand out or certain things that you've done that have led to getting more referrals?
Yeah. So let's just for conversation's sake, say that we do great deals every single time we do a great deal, right? And that's like off the table, because I think that's number one, right? You have to make sure that you're doing great deals, or else if you're consistently doing bad deals and losing people money, it doesn't matter how great your service is going to be. They're going to find someone else. So let's say that we're always doing great deals. The tactical things that we do outside of the great deals is that we're extremely transparent, and we've gotten feedback that we're probably too transparent. How we view our investors is actual partners on the deal, right? Because this is a partnership interest, right? They're investing as a partner, a capital partner on this deal. So we feel any issues that pop up with an investment, or any good things that pop up on an investment. Obviously, you want to relay the good things, but anything that might not go as planned is important. And they should know about it. So we disclose pretty much all of that in our quarterly reports, both the good and the bad about an investment, but also we'll touch base within a quarter regarding maybe something that took place, a capital project, a leak, just the natural things. Maybe we had to do a roof repair. Those are things that we typically don't wait. Like if it happens in January, we wouldn't wait until the end of March to report that. We would make sure that we're emailing our investors as it's happening. And I think that's something that doesn't happen a ton, is people feel like there's a massive delay between when something happens with the investment that they're a partner in versus when they hear about it. And that we try to reduce the amount of time that something is happening on the property versus to when our investors actually hear about it. So that's one, is just extreme transparency, to the point where people are telling us that we shouldn't be that transparent. And then two, it's the consistent, it's being consistent in when you're outreaching to people, like at the end of each quarter with the quarterly investor statements, as well as the K1s, right? Like you build a brand off of consistency and reliability, and our brand is known to our investors as being extremely consistent and reliable as far as when we get documents to them. And then lastly, it's the simple things that a lot of people look over. It's remembering birthdays, remembering when their kids are graduating college. It's remembering when they have an anniversary. It's remembering when a loved one passed away, right? It's can be a number of different things. And then just making sure that we're connecting with them on those dates and just saying, hey, I appreciate this, or congratulations on this, or hey, just wanted to make sure that we sent you a kind, or we're thinking of you, right? Because we know that a few years ago your father passed away. So it's changing this whole stereotype of institutional finance transactional relationship between an investor and a company to, hey, we're your pals and we're your buddies, but we also do great deals for you, right? But let's set aside the great deals and just like let's be friends, right? And if you don't want to take it there, that's fine. But that's how we like to do our business, is we like to see our partners as friends and to interact in that sense.
Yeah, and I love that approach of taking the kind of the coldness out of what can be, this industry and these types of transactions, especially with other operators out there. They may just, be so focused on getting deal flow and putting deals in front of their clients, and that's not necessarily a bad thing, but I do love the approach that you guys are taking to really add that personal touch to everything that you guys do and make the investors feel, like they're part of this family and a part of, something that's not just a real estate investment firm. This is a company that they want to do business with and want to stay in business with and keep funding investments with. So I really appreciate what you guys are doing on that end. But switching gears a little bit on your side of things on some of the skills that is there anything that you feel that, with it being the Mastering Commercial Real Estate podcast, any skills that you feel like you've mastered and this is, your biggest strength in what you do? And on the flip side, any weaknesses that you may compensate for, and what do you do on that flip side of the coin?
Yeah, no, really great question. I'll say this, and this is just the way that I was raised, and I don't think I'm a master at anything. Right? I think I'm very, very competent at certain things. And I think that there's always room to grow, right? I wouldn't say I'm a master in anything, but I think I'm extremely competent in a few areas. And I try to leverage those as much as I can to fit into what I do on a day to day. One thing that I actually am I really don't like, if I should say, but I'm extremely competent at, because I understand it's probably the most important thing that you can be good at when it comes to real estate, is being an extrovert and going to networking events, meeting new people, and how I challenged myself to do that. And I would say this is an extremely great practice that anybody should do. And it's what I did when I first moved here and started brokerage. Was I found a couple different coffee shops that all the real estate meetings are happening at, essentially. And I don't know if those are happening in other people that are listening to this, if you guys know where those places are, but there's a few in Denver that I knew, all the top developers, brokers, operators, property managers, whoever it is that touches real estate. It seems like all these meetings are happening in these few coffee shops. And I would go and sit there for a few hours on a few days, right? And I would just listen and eavesdrop, right? And I would figure out who's having these real estate conversations. And I would walk up to their table and I would say, "Hey, I know this is really weird. And if I'm intruding, like, please tell me. And, I can circle back around when I see you guys picking up and packing up and getting, leaving. But if it is a good time, I'd really love to have the chance to connect with each of you personally. And I'm new to the market, and I'd love to hear how you guys kind of operate here and what you do." Right. And I would pass business cards, and that's how I started meeting people. And it was really uncomfortable. But if you can do it in a coffee shop, it makes walking into a networking event where the sole purpose is networking 10 times easier. And you also learn a few questions that work really and resonate really, really well with people. So all of those, again, just tangible things that I learned, but took a little bit of discomfort to learn, but they translate really well into intro meetings with investors and identifying motivation and managing investors' expectations of an investment, and then ultimately helping them, I guess, come to the point of, hey, this is a good decision or this is not a good decision. Because ultimately that's what I want to be, is I want to be a place where somebody can qualify a real estate investment. And you only do that by asking qualifying questions that make them think about the decision that they're about to make. Because you don't want an investor that thinks they're investing into one thing and not actually investing into that thing. And so in order to do that, it's question asking. And part of my job is qualifying an investor, and then part of their job is qualifying me. So I can kind of do two birds with one stone by asking good questions. So I guess that's one thing. Is I think one of my strengths is asking questions, and is kind of allowing people to understand, if they didn't realize it in the beginning, what their own motivation for investing into real estate is, and then if that aligns with what we do. And then two, I think it's just being a human. I think I'm really good at setting aside like this, people use, a bunch of different terms in real estate, and it can become intimidating. And I don't hopefully come off as the person that knows everything. And I think I try to create a really calm and fun environment to talk about real estate. And then, I ask questions back to them. I think that's the number one thing. And I just said it earlier, is like, you create a great environment for people to engage with you by engaging with them. And if you think that you know everything and you're just expecting them to ask you the questions and you be the expert, then you're not creating a very collaborative relationship or environment. And that's a big thing that I learned early on by doing it the wrong way. Now I've since learned. So I think those are probably the two things that I do pretty well. And if I could toot my horn in one way, it'd be breaking the ice with people and having engaging conversations, and then question asking.
Yeah, and the networking is always a difficult aspect for a lot of people, and I think that was a lot of really good tips there. Talking before the show, me going to those networking events over the weekend, even me being as extroverted and people oriented as I am, I can still have the awkwardness out in networking events and not feel confident sometimes, especially in a new crowd and, somewhere where, I'm not sure how much I'll have in common with a lot of folks. And so one of the things I've been doing, I'm been going to this event or this organization's meetups pretty frequently, and they have a lot of them. And so I've kind of just been meeting the people who put on the event and introducing myself to them. And one of the tips that I would impart on you, the listener, is, if you're in that spot, ask that person, go and meet the director. They put this thing on. They know a lot of the people, and ask them for an introduction. Say, hey, I do this. I'm kind of looking for this type of person. Is there anyone around here that you may know of that would be good to meet? And then they'll put an introduction together. And then the other thing is, if you're going to these events frequently and you're kind of being a wallflower, just take notice of who is there frequently and who is there a lot, and say, hey, I've noticed you at quite a few of these things. And that's a great icebreaker right there. And so, yeah, I think just learning your icebreakers and finding questions that you can ask that are fun and engaging and get them to talk more. I think you said it well. You want to be asking them a lot of questions and qualifying them, but you do want to get them talking more than you want to talk. On that note, turning it back to you, where is some of the skills that you've learned? What were some of the early lessons? Was it underwriting? Was it investor relations, capital raising skills? What were some of the early skills that you were learning when you got into the industry following the NFL career?
Yeah, so this might answer both questions, but I want to make sure I circle back to, because I don't think I answered, what are some areas that I'm not as proficient in? Because I think this hopefully resonates with a lot of the listeners, whether you're in real estate or just trying to get into real estate. Is one of my weaknesses, I guess you could call, but I actually think it becomes a strength, is that I'm 27 and have only been in this for a few years, right? And I think a lot of people have imposter syndrome or feel like they are too young to be having qualified conversations about real estate because they don't have the experience. And I think, and this goes to your point of the question that you just asked, was one of the things that I learned was vulnerability sometimes is the greatest way to have, to one, create a relationship, a two-way relationship, one that's not just you forcing a conversation, but one that tells them like, hey, I don't know everything. I'm not claiming to know everything, but I will learn something if there is something for you, for me to learn. And I'm willing to tell you that too. And I think that one that like takes walls down right away, and allows you to have a much more human conversation than one that's just like, what's the cap rate? What's the IRR? How is this going to net benefit me financially? You can start getting deeper into like what they're vulnerable about and what they're nervous about. And then, vice versa, what I'm vulnerable about and maybe what I'm not as proficient in. So that was something that I learned when I transitioned from the NFL into this, because the NFL is all about no vulnerability and making sure that you are, if you've got broken bones, nobody's ever going to find out about those broken bones, because that means you're less reliable, because your reliability is your ability to play. And so you hide everything and you don't talk about your vulnerabilities, if it's physical, mental, whatever it is. So transitioning into real estate, I realized that that's kind of a superpower, is your ability to be vulnerable, when maybe traditionally, in the real estate space, that was not a thing that you did. But I think a lot more people appreciate your ability to have those vulnerable conversations and say, yes, I know I am young. And yes, I know I don't know everything. But the beauty of it is like, my runway is a lot longer than some of these other people. And my ability to say those things now and to actually follow up on the things that I don't know and learn them is a really, really powerful tool that people respect a lot.
Yeah, and just adding that human element, and this is obviously a common theme with everything that you do and what you've brought to the table at 4 Mile and everything that you've done in the past, is being able to connect with people. And yeah, that vulnerability is huge, and to prove to people that, hey, I can talk the talk, but I'm not just a brick wall here. These are people that you can spend time with and connect with. And that's a really important thing, because that's how you build these relationships. And as everybody knows, in real estate, it's a very much a relationship based business if you want to continue to have success. And so, speaking of that, what would you say is your biggest success to date?
Oh man, that's a great question. I think probably for me, most capital raisers are 10, 20-year vets that have a ton of relationships and a ton of business acumen and real estate acumen. So I think a big success for me was the ability to leverage what I did in 2 years to be able to find my way into a small growing company. We're about 600 in AUM right now, 600 million in AUM, and manage the investor relations, and then also be the forefront of the brand to bring in new investors. So I think that was, that moment for me, getting the opportunity to do that at such a young age was kind of proof to myself that what I did these past 2 years of prioritizing my network over just a transaction was something that paid off in the eyes of some of these private equity firms that are that I wanted to be attached to. So I think that was a big success, and then ultimately coming in to the company in the middle of a $20.1.5 million raise, which was the largest that we'd ever done in the company, and then being able to contribute to that. And then ultimately now running a capital raise that's 9.1 million that we're currently in, that we launched about a week ago, and being 80% allocated. So it's the fastest that we've ever been able to raise capital. And that, is hopefully, knock on wood, all goes well, I'll be able to show the tangible value that I've been able to bring to a company as somebody that is younger in the business.
No, that's incredibly exciting, and that's no small feat to be able to raise that much money in such a short amount of time, and especially in the capital markets and private equity, it can be really hit or miss on how much capital is going to be raised in a certain amount of time, and there's not a whole lot of leading indicators that will give you that until it's time to send the emails out and start making calls. And so congratulations on that. On the flip side of things, talking about the biggest success, was there any large challenges that you faced that didn't go as planned, a deal, a capital raise, or something like that? Even dating back to your athletic career, what was one of those large or biggest challenging moments, and what did you learn from it, and how did it shape your approach to what you're doing now?
Oh, that's a really good question, and you're gonna make me get vulnerable right here. So, I mean, for me, my number one goal my whole life, for much longer than I've ever been in real estate, was focused on football. And I had in third grade, we did this write what you want to be when you're 25, and I wrote like a professional football player, and my teacher gave it back to me and was like, hey, write something that's realistic. And I don't think that there's any malicious intent there. I think that a lot of kids say they want to be a professional athlete and all that stuff. Anyways, I took that, and then I handed it back to her at the end of the class, and it said, I want to be a professional football player. And I said, so I ultimately just handed her back what she told me to change. And from that day forward, I don't know if it was that exact day or if it was a culmination of a number of events. I set my focus on, like, I was going to become an NFL football player. And I sacrificed a ton growing up, like the parties and the social aspects and the drinking and all these different things that people get involved with and create their social community. I sacrificed a lot of that because to me, it was important to make my childhood self proud of the journey that I decided to take that maybe others didn't. And one of the biggest failures that I felt in the moment was getting cut from the Bengals, because I felt like, for me, at that point, 18 years later, I had let myself down, but ultimately let the people that had jumped on that wagon with me, I had let them down, because there's a lot of all-encompassing we's that take place with the people that are supporting you. Like, hey, when they're talking about it, it's like hey, we made it, or yeah, we're doing this, right? Even though they're not doing it, it becomes like a larger than you situation. So when it doesn't work out, it feels like you let yourself down and a ton of other people down. But what I had to remember, and the place that I've gotten to, and it's why I'm so passionate talking to other athletes that are making the transition, is long before you had a wagon of people that were supporting you, right? It was your third grade self that was the only person that believed in you. And I think the same thing happens in real estate, right? When you go into brokerage, it's an extremely lonely career. And you might have people that say, oh yeah, you can do it, or yeah, do this, or right. You might have some support pieces, but nobody's actually there to wake you up at 6 a.m. or 5 a.m. or 4 a.m. to make the 500 calls a week or 400 calls, whatever it is that you're doing, to go on the awkward meetings, to do all those things. And 10 to 15 to 20 years later, right, you start really seeing the fruits of your labor in brokerage. And let's just say you did 15 to 20 years in brokerage, and then all of a sudden somebody told you that you couldn't do brokerage anymore. That would be that would be tough, right? Because you've built your bandwagon, you've built your momentum, and then all of a sudden it just ends. So that was tough for me. I'm thankful I'm at a point. My wife is a huge supporter of, diving into like the emotional side of things and kind of getting yourself into a more vulnerable state to realize what are the underlying reasons you feel certain ways. So without her, I would not be able to have this conversation. So that's a plug. I encourage everybody to have those conversations and to find people that you can. But yeah, that was probably my biggest quote unquote like failure moment that I had, was just having to pack my stuff up and leave the Bengal Stadium, knowing that like all these people were going to be waiting there with questions and feeling like I let them down.
Yeah, no, I mean that's a very tough experience, and that's a high and a low all in a pretty short amount of time after so much time. And we all go through our own versions of that. How would you describe your mindset now, and what are some of the things that you used to kind of get over some of those mental gymnastics that you have to figure out following this and getting into a career and kind of pulling yourself back up by the bootstraps and getting back out there and going and being successful?
Yeah, I mean, that is like, that's a whole nother podcast in itself. But I think like to be quick about it, I think we're all pushed so much in our lives to live 10 years ahead, right? And to plan for the 10-year mark or the 5-year mark or whatever it is. So you're always consistently living in this life of that you're not actually at, right? And if in 10 years, if your goal is to be a millionaire and it's to have this type of car and to do what, like if that's it, and then you're currently sitting in a 400 square foot apartment with a junker car outside, living on food stamps, which is like what me and my wife did for a little bit, it makes you extremely depressed every day to wake up and not be at your dream, right? And I think one thing that I would encourage people to do is have those goals, right? I'm not saying don't plan for your future, have those goals that you're driving towards, but a lot of times people forget to like really enjoy the journey and enjoy like where your feet are at. And that's something that my wife taught me a lot, is just be present where your feet are, right? And enjoy the current circumstances, because one day you'll get there. And when you're there, you're going to wish that, that it was just you and your wife in a 400 square foot apartment trying to figure out how to use food stamps to buy your chicken and rice, right? Like those moments are so important, and love grows really strong in small spaces. And you figure out who your really good friends are when things are tough. So to just jump to all the success and all the glory would be actually extremely lonely, right? And those stories and those memories that you create, if you can just prioritize being where your feet are going to make, once you reach whatever your 10-year goal, so much sweeter. So that was not something I did well until I met my wife, and she really pushed me to be present. So I'd push everybody to just challenge yourself 5 minutes in the morning, just figure out what you're grateful for today instead of what you're going to be grateful for in 10 years. Figure that out like today, right? It makes you a lot more appreciative of where you're at.
Yeah, I couldn't agree more with that. That's something that I personally can struggle with, just with how, being ambitious is kind of a gift and a curse, depending on how you look at it. And if you take a look at it the other way, it can be a curse, but it can also be a gift. And when you take gratitude for where you're at and what you're doing and how far you've come, no matter where that is and where you're headed and things like that. And yeah, just taking a few minutes just to say, hey, got a roof over my head. I've got this, I've got that, I've accomplished this. I'm working on this. This is exactly where I want to be, where I need to be. Those can be different things, where I want to be and where I need to be and where I am. But yeah, I think just taking a moment, taking a beat just to appreciate, where you are today. I think that's a great piece of advice. Is there a routine that you follow during your day or during your week that leads to a lot of success, that is either, a routine at the gym or sales practice? What are some of the things that you do personally and professionally to keep the days and the weeks productive and moving forward towards your personal and professional goals?
Good question. And also, I just want to say what you said previously in response to what I said was spot on, and I appreciate your input is awesome. So appreciate that.
Thank you. No, I appreciate it.
Yeah, and to the question you just asked, yeah, I have a process just to create some consistency in the beginning of my day. What I've figured out over the years that just like sets me into like a good place to take on whatever the heck the day has to take on. What I would say is that like my days after 9 a.m. vary widely, and there's not a lot of consistency when it comes to that. So that part is more difficult to create consistency around. But from 4:15 when I get up to 9 a.m., I have a pretty consistent routine. And it's right now I'm training for a half Ironman. So my training is from, 5 to 6:30, 7 every day. And then when I get done with my training, I get back here, I make whatever I have for breakfast, and then I read 10 pages of my book. And it's not a ton. I'm not a guy that reads 2 books a month. What I said is my goal is, 10 pages a day, 6 books a year. So that's about one book. That's one book every 2 months. And if you kind of do the math, right, 10 pages a day is 300 something pages, which is typically the length of a book. So then if you do 10 a day, you can probably get through 6 a year. And then outside of that too is I take 5 minutes to, like I said earlier, figure out what I'm appreciative of today. And that kind of centers me to be as present as possible for whatever the heck is going to take me either forward thinking or backwards thinking with investments that we're trying to get, investments that we currently have, and different conversations that take me to different places in my life. So it's just a good reminder to try to be grateful for whatever current situations that you're in, whether they're good or they're bad. And then that's typically the last thing I do before I go into my meetings, which typically start around 9 a.m. So it's not as probably structured out or as like, I eat 3 packets of oatmeal with honey and raisins every day. It's probably not like that, but there's a few things that I do every day before 9 a.m. and it just puts me in the right headspace.
And so, for example, with this capital raise that you're working on right now, what are some of the, for somebody who maybe doesn't understand or have any knowledge of what this process looks like, what are some of the things that literally occur? Okay, we've got a deal, boom, we're in due diligence, we're going out and raising money. What are some of the things that happen next for you and your process and your system of raising the capital start to finish?
Yeah. Start to finish. So, I mean, obviously first, once we find a deal so I'll start from the basis, right? We have investment committee every Thursday. Investment committee is where we start looking at the deals and qualifying them to figure out if they'll connect with our investors. Once we identify some deals that we want to put offers on, let's just say we put an offer on it, it gets accepted, and we're in an LOI negotiation. At the LOI negotiation, we reach out to our waitlist investors, which are the individuals that did not get into our previous deal but intended on investing. So they get a preference, a head start of 48 hours to our current investors to see the deal and ask the questions that they need to ask in order to get into the deal before it potentially fills up. And the way that we do it is we do non-binding commitments in the beginning because we're a first come, first serve basis. So if people think that they're intrigued by the deal, they can come and invest 50, 100, 200, 250, whatever the amount is that they want to allocate to reserve their equity portion. And then they can go back and do their due diligence and try to figure out if this is a deal that connects with what they want to do. So that happens first, the 48-hour head start to the waitlist investors. After that, it goes to our current investors. And then after a 5-day period that our current investors and waitlist investors get, it goes to our prospects. And then through that process is just having an efficient way to track the questions that people are asking, who's committed, who's not interested, who asked questions, who said, hey, I need some time to look at it, I'll follow up. Because maybe a weekend happens and they forget that they were looking at it, but they could actually be an investor, right? So creating these systems and tracking tools to make sure that you have categorized everybody to then try to figure out, okay, in 7 days post our investment launch, I need to start my outreach, my follow-up process to active and current investors and prospects. So that's all laid out on a timeline. It's typically a 60-day timeline, which includes like sending out subscription documents and operating agreements and getting signatures and building our 20% over investment, which is our waitlist investors. So all of that is like on a very defined timeline that we track. On day 5, we want to have $5.5 million invested. On day 10, we want to have $7.2 million invested. And then we're tracking that as those days hit to say, hey, are we hitting this or are we not hitting this? To then go back and look at that on our next raise to say, this is what we were able to do with this type of deal. And it will allow us, one, to understand how we can negotiate our terms in a contract to be most competitive, but also protect our brand and our ability to close on a deal.
Yeah. And when you're putting together that system, because putting together metrics for a capital raise can be pretty arbitrary because it's truly dependent on what's happening on the other side of the phone and the computer when you're talking to the investors and getting their capital secured, wired up, their commitments and things like that. So when you are tracking these, you have that set expectation beforehand, or is this a new system or something that you guys have been tracking for a while?
So this is a relatively new system that I put in place when I got here. I was really intrigued to know like what percentage of our investors are new versus current in every deal. What is, from high net worth to family office to RIAs to 1031s, like what is the percentage of our total equity that's contributed by each different segment of investor, and then on a per deal basis. So getting as granular as possible is important to me to understand where we're getting our capital from, and then also understanding that on a timeline from the day that we launch, from the time that we launch on that day, right? Like what is the most amount of response that we get, whether it's 4 p.m. Eastern time, 2 p.m. Eastern time? Is it Thursday? Is it Wednesday? Is it Tuesday? I mean, is it Saturday morning, right? Like when should we be sending these out? Who should we be sending these out? What's the amount of time between each email that we should be sending these out? And then who are we typically seeing response from? And who makes up our capital? I think like having a system to track all of that is extremely important. Then the other thing, I can say I have 500 active investors, but when Q4 comes, how many active investors do I actually have? Let's just say we do a deal a quarter, right? But we have 500 active investors on January 1, and then there's 250 of those investors are only investing in one deal a year. So by the time we get to Q4, if all those 250 have invested, and then maybe another 150 only invest in 2 deals, right? Now we're dealing with like 75 to 100 potential investors that we can actually raise capital from. And if you don't track that, then you might get into a massive deal that you're not actually able to raise capital for because you don't understand what your source equity actually looks like. So that's what I've been doing, is like how granular can we get to figure out who our investor is, where our investor is, when they like to be interacted with, and then what their equity checks are. So that when we get to Q4, if we find a deal that requires a $25 million capital raise, can we do it ultimately? Because if we say we can do it and then we're not able to close, that broker is never coming back to us with another deal. And that's our brand. That's important to me.
No, and when you're looking at this data, what are some of the insights that you have discovered? And obviously this can change depending on different companies, areas, geography, things like that, relationships. But what are some of the insights that you have found from the data, from taking a look at it? Are there better days of the week and times that you find that investors are responding to? Is there certain messaging in the email blasts or anything like that? I'm sure you've done some different styles of messaging, or do you just have one single template that you send out?
Yeah, so I'll say from what we found, and again, this has been tracked over the past 7 months now, and 1.5 deals because we're in the middle of a raise right now, so we're constantly tracking this stuff. What I found, what was interesting, right, is like you start getting into the family office space, and you're like, man, this is awesome. They're doing $1 million, $2 million. When you break it down and you see what percentage of the equity they actually are, like family offices with us are, I believe, and don't quote me on this, but I believe they're like 4 to 5% of the total equity that we contribute to a deal over our 16 property portfolio. So when we are, considering where should we spend all of our time and effort to attract new investors, understanding what percent of the equity that each person holds, and also like what the potential could be for them to hold is an important thing to factor in. So understanding that they're only 5%, you get away from shiny object syndrome pretty quickly by saying, man, I only want to focus on family offices because they're writing awesome checks and they're passive and they're X, Y, and Z. And that would get you away from the 95% of your equity, which is the high net worth individual, right? But maybe they're only writing $50,000 to $150,000 checks. So it's a lot less shiny looking, but it's actually a lot more impactful to your company to focus more of your time and effort on those high net worth individuals because they're the ones that might be able to backfill the family office that had $1.5 million equity chunk that backs out at the last second. So if all you're focusing on is the $1 million to $2 million checks, if one of those backs out in the last yard, you probably don't have another person that has $1 million or $1.5 million that can backfill them in two or 3 days. but you might have a wait list of a few $1 million of high net worth individuals that you can allocate strategically on $50 to $150 check sizes that don't cost you any economics on the deal. So you don't have to go and get pref equity. You don't have to go and get anything like that. So it's a lot more of a malleable source, but understanding that allows us to say family offices are great. We want to connect with those people and we want to prioritize those to a degree. All of our track record focuses that the high net worth individual is the most beneficial economically to our company. So without that data, it'd be hard to tell. And then, yeah, like when it comes to days and hours and times, like we're still tracking that and it's not a perfect science. But, Thursdays at 4 p.m. Eastern time have been really beneficial for us. And I don't know if that's just because of where our clientele falls or what. We're still trying to get down to the nitty gritty of that. But that's what we've seen is the best time for us to be sending out our deals and communications, broad scope to our investors.
Interesting. And what's kind of the main differences between working with these family offices, raising money from them, and raising money from just other limited partners, your retail investors?
Yeah, I think it's probably like the systems that these family offices have in place and the reportings that they're expecting. The typical high net worth individual has an amount that they're allocating towards alternative investments every year, right? And they don't want as much involvement as maybe a family office does. And I think like there's pros and cons to that. Look at some high net worth individuals and I'm like, man, I wish that you guys would be more involved because I think I think it's great for people to be extremely involved into where they're placing large amounts of capital, which is a pro, I think, of the family offices is that they're extremely educated and they have whole portions of their offices that are focused on real estate and qualifying deals. So the interactions with them are a little bit different than the high net worth. I think where the difference truly takes place is the cost of capital and what they're looking for as far as deal level returns versus what high net worth investors are looking for when it comes to, net investor returns versus what high net worth investors are looking for when it comes to net investor returns. It seems like high net worth individuals are looking for IRR focused deals, while family offices are looking for depreciation and supplemental cash flow. So finding a way to balance both of those, but then also educating both on why one is important and why the other is important. And then finding a balance in between both is important because we can't just cater to one over the other. We've got to cater to both. Unfortunately, it somewhat seems like high net worth is typically more focused on IRR, and then family offices somewhat more focused on cash and depreciation. It's, that's how the conversations differ and probably the interactions with our deals differ too.
No, that's great insight. And as we wrap up here, just a couple more questions. If you could go back in time, give yourself any advice, when would you go to, what period in your life would you go to, and what advice would you give yourself?
Holy heck. Boy, that's a great question. Let's see. I would probably go back to when I was getting engaged and I just got cut from the Bengals. I felt like, and for whatever reason, I don't know why I felt this way, but I felt like I was like lesser of a man, right? Because I didn't have a job. I just asked this amazing woman, like the woman of my dreams, to marry me, but I didn't have anything that I felt like I could show for it. Like I didn't have any stability that I felt like I could give her. I couldn't buy a home, so I didn't like that security aspect. I just felt like I was like a lesser of a man asking this woman to take a chance on me. And I think I'd go back to that moment and say like, that is like such a lie. And I think a lot of guys chase that for a lot, like for a majority of their life is the ability to say like, I am this or I am that. And I think I would, I'd just love to have a conversation with myself back then and just be like, you are these things. And just because it's not like happening in your life right now doesn't mean that you're not, successful in a multitude of other ways. Your ability to have conversations, both deep, both personal and professional, like that's a very successful place to be, right? And a very successful skill to have. And then your ability to have somebody that loves you, right? Like that is rich to me. And that is stability in my life. So I think like just having that conversation with myself a few years ago would have been great.
Love it. No, that's great advice. And that kind of hindsight 2020 situation, and you can even just run the data up to now, say, hey, what would my 5 years from now self tell me now? And kind of give yourself that advice. What advice would I give myself right now for any struggles or issues or challenges that you're going through? I think that's another good piece of advice. One last random question before and you can choose. So you can choose one or the other. Or heck, no, let's just do both. Let's just do both. First car, first job ever.
So first car was we called it the Golden Nugget. It was like some early dozens Toyota Corolla. That thing was sweet. And honestly, like for any broker getting into the game, a Toyota Corolla, that thing never like failed me. It always turned on. We ran that thing up over 200,000 miles. None of the like engine lights ever went on. It was awesome. Any aspiring broker looking at Toyota Corollas, screw the whole perception that you got to roll up into a G-Wagon, like whatever, right? Go get a Toyota Corolla because those things are reliable. First job, I believe it was, and I don't know if, hopefully nobody gets in trouble for this. Like I was like 14 or 15, working in the back. No, I was 14 or 13. Yeah. What is 8th grade? How old are you in 8th grade or 7th grade?
Oh,
is that
God.
13,
like,
14?
Yeah, 13,
something
14,
like
something like that.
Okay. I mean, outside of just like mowing lawns and all that stuff, like my first job was bussing tables at this pizza place in downtown Long Grove. And man, it was the most disgusting job I've ever had in my life. But a lot more respect for the service industry after doing that.
Yeah, I'm always curious to know where people's first job, first experiences were. So I love that. And then any one last piece of advice for the listeners before we take off?
I would say the greatest thing that I ever learned was to manage my own expectations, and to respect your time. I think in the beginning of your career and even in any part of your career, you feel like your time is not valuable enough to say no. And ultimately, that any time that you are allocating to other people is time away. The way that I see it is time away from my wife, right? And finding a balance act between that is extremely important. So figure out what your priorities are in life and figure out what your walk away point is. And ultimately, I think people end up respecting you a lot more when you have boundaries and your ability to draw a line in the sand. Because if you don't stand for something, you don't stand for anything, right? And in real estate especially, people value people that have boundaries and standards and respect for themselves. So I think just as you're in it, whether you're a 10-year, 20-year, 15-year vet, or you're just getting into it, figure out what those are and don't compromise on whatever boundaries that you set in your life. Because it is really easy to, especially when you're first getting into it. And I did. So I don't want people to feel bad if they do compromise on that. I did. But just make sure that you have those set and you remind yourself constantly of what those are.
I love it. I love it. Jack, it was an honor and a privilege having you on today. I really appreciate it. Thank you so much.
Yeah, thanks, Cory. Appreciate having me on.
Well, guys, this has been the latest episode of the Mastering Commercial Real Estate podcast. This is Jack Sorenson. I'm your host, Cory Mortensen, and we'll see you next time. Well, that's a wrap for today's episode of the Mastering Commercial Real Estate podcast. Thank you so much for listening. If you enjoyed the episode, go ahead and give it a like, leave a review, or share it with a friend. It really helps us grow and reach more people who want to master this space. If you have any feedback or ideas to improve the show, reach out, leave a comment. I'm always looking to make it better and tell us what you like or didn't like. And don't forget, if you're ready to start investing passively and want to learn more about upcoming commercial real estate deals, head over to ONE-9 Holdings, that's 19 Holdings, and join the investor list. Thanks again for listening, and I'll catch you on the next episode.